Okay. All right. Well, welcome everybody. This is the Q3 2024 webinar. Thoughts on recent market volatility. There are times with financial markets and stock markets in general that when you see a random move, like we've seen a pretty big sell-off in a short period of time, there are times where the culprit is really difficult to identify. Markets can move around on very little and can kind of catch fire up or down, not on anything fundamental. But this time, it's much easier to identify what's going on, believe it or not. So we're going to talk through that. Obviously, it's been a pretty big dip in the market. It's only been about a week or two, and the market's down about 10%. So pretty big move, seemingly out of nowhere. It is this carry trade. So I assume we're kind of going under the assumption that this is a relatively new financial term for most of you. So what we're going to do is we're going to start by just looking at what a carry trade is. We're going to look at some components of that, which are currencies, the Japanese yen. We're going to look at the Japanese Nikkei, look at semiconductors, kind of look at the timing of when sell-off started. I think we were really able to understand this move better when we line up a few different asset classes next to each other and see the waterfall that happened. Big spike in the VIX. We got almost up to 70. We're going to look at the S&P 500, talk about spreads, and look at some credit default swaps to see if this is spreading from China into Taiwan or Korea. So bear with me with the terminology. It's really not as complicated as you might think. So as we get through the terms and kind of understand what is happening, hopefully we can help put some clarity in a simple way. So let's go ahead and dig in. Also, let me go ahead and say also we love questions. We had people send in some questions beforehand via email. Also, if you're on the webinar right now, there's a couple places that we're going to take questions, and please feel free to type these in anytime you'd like. The first one is in the chat, but there's also a Q&A button. You might have to hover over the Zoom sort of toolbar and hit more, and there's a Q&A there. But if you put a question in either the chat or the Q&A, we'll be sure to get it. And if it's relevant to the slide, I'd like to go ahead and address it while we're talking. So please don't hesitate, or feel free to ask throughout the presentation and not wait till the end. So let's get into it. Carry trade. Like I say, probably have not seen a whole lot of this. Probably do not have a whole lot of experience with it. It's a fairly simple concept when you understand it. It just has to do with currencies. So what a carry trade is essentially borrowing money at a low interest rate and trying to earn interest on that money higher than the cost of debt. With a yen carry trade, the reason that the yen carry trade has become such a big part of the global financial markets is because for decades, Japan has kept interest rates at zero. So it has reliably been the lowest interest rate currency to be able to borrow. And when we're talking about borrowing currencies and borrowing for a carry trade, this is not an individual borrowing, $20,000 to do some trades. These are big institutions borrowing millions of dollars, tens of millions, hundreds of millions of dollars, and doing these kind of trades. So you borrow money in yen in Japan, a lot of times directly with the Bank of Japan Central Bank. Those funds, let's say it's just use a round number, it's $1. $1 of yen gets converted into US dollars. It could get converted into Australian dollars. It could get converted into euros. So it can go into multiple currencies. The Australian dollar is a very popular currency for people to trade with the yen because the interest rates there have been kind of consistently higher than the yen. So there's naturally some arbitrage that can happen. Once that money is converted into US dollars, that can be then invested in various ways. It could be the easiest way to think about it is if it was just invested in cash. So cash in the US is, let's call it 5%. Cost of debt in Japanese yen is, call it a half a percent. So if the currencies stay the same, the carry trade is going to earn a 4.5% spread on borrowed money. It's kind of free money in a way until things change. But this concept of an arbitrage where your return is greater than the cost of the borrowed funds is all the carry trade is. It just involves a couple different moving pieces, which is the currency conversion. So with the currency conversion, if the yen strengthens, then to convert from another currency, US dollars, back into yen, it takes more US dollars. So that returns if the yen appreciates, let's say 2% against the US dollar, that 4.5% spread or carry becomes 2.5. So the currency can either help with the returns on the carry trade if the borrowed currency falls. It can hurt if the borrowed currency increases because converting it back and paying off the debt, you have to convert into the currency. I hope this makes sense. It's basically a way to earn more money than you pay in interest. That's the carry trade. When we look at the size of this carry trade, we're going to talk about the mechanics of this here in a minute. When we look at the size of this carry trade, it's really difficult to pin down how much of the Bank of Japan's balance sheet is being used in this manner. It's really not tracked. It would have to be some kind of self-reporting because once somebody borrows money from the Bank of Japan, converts it into another currency, it's not like there's people just looking at every thing along the way. So it's hard to tell how much of this is part of this carry trade, but generally speaking, the Bank of Japan balance sheet is giant, roughly $20 trillion. And compared to the U.S., if we look, the balance sheet is bigger in Japan, both on a nominal amount, so 20 trillion versus 6 or 7 trillion in the US. But when you look at it relative to GDP, it's massive. The Federal Reserve's balance sheet is 25%. This orange line down at the bottom, orangish, reddish, brick color, if you will, is 25% of the US GDP. Japan's central bank balance sheet is 127%. That's massive. So when you see the balance sheet being this big, when you get movements in interest rates within there and movements of this carry trade, that's a lot of money relative to um, that economy in that country's stock market. So it's a very, very big relative number. The reason we bring this up is it's hard to tell what percentage of the way through we are with this carry trade. So we could be 100% of the way through, and yesterday was the low. That would be very good. We could be 50% of the way through. So that's one thing that we have to watch to see what's happening over the next few days because we're not sure exactly. We really can't determine how much of this process is done or not. One of the reasons why we could see some additional volatility over the next week or so. And again, please ask questions. I hope this is making sense. So let's look at the yen versus the US dollar. This is a shorter term chart, so this goes back to November of last year. When we look at this chart, what it shows is when this line is going up, the yen is strengthening against the dollar. When it's going down, that's weakening versus the dollar. And when the yen is going down, that helps support the carry trade. So if there's a 4.5% spread on US cash versus Japanese cash, and the yen currency falls, let's say it falls 2%. Well, then when you repatriate US dollars back into Japanese yen, you get the 4.5% carry plus an additional 2% from the currency depreciation. So that's been a very popular trade globally for many years. This spike higher is what caused this massive sell-off. It's leverage. So these are borrowed funds that this carry trade is on is being based on. So as the cost, there's two things that happen. There's one main thing that happened that started this whole domino, which is the Bank of Japan had a surprise rate hike. The market was predicting only the high 20% or so, 26, 28% likelihood that the Bank of Japan was going to raise rates, and they did. So, usually it has to be 90%. The market thinks a 90% move is pretty consistent with a central bank hike. This was a very low probability hike, so it did come as a surprise. So we've got that sort of first piece of information to tell us that this is a possibility for causing this sell-off. But this is a pretty big move. This is a short-term move, so it always is beneficial when you're looking at any kind of market to zoom out. So let's zoom out on the Japanese yen. We showed this yesterday, showed these two charts yesterday in the report we sent out via email. When we zoom out, this is that move that we just looked at. It looks giant when we zoom in here. When we take it in context, it's really not that big. So, for this to cause this kind of volatility, it looks like it's happening very quickly. It's not this. Maybe this is a bigger trend change in favor of the yen, but at this point, that's just not a very concerning move. It's a pretty minor move. It has caused a lot of volatility in a short period of time, but it looks like the move, based on some of these charts that we're going to talk about, it looks like the move could have been a little overdone. So the long-term Japanese yen chart really doesn't look all that bad. However, um, the Nikkei stock market, so part of borrowing money in Japan doesn't necessarily require that you go into another currency. There's plenty of people and institutions within Japan that are borrowing money cheap and putting it in the Nikkei stock market. So when that happens and the cost of debt goes up and you start to get selling in the stock market, that's where you get this waterfall panic kind of get out at any cost. In a pretty short period of time, matter of a couple of weeks, the Japan's index is down 28%. This is really a crash. We're saying there's people on CNBC saying that the U.S. is in a crash. A 9-10% move lower is not a crash. 28% in a few weeks, that's a crash. So, we've seen a pretty big jump today. It was up 12% at one point. It's faded a little bit. We're going to talk about levels that we're looking for here in a little bit, but the Japanese stock market has undergone some damage. So let's line these things up together. What this chart does is it looks at the yen, the Nikkei, and the S&P 500 all on the same chart. And the reason that we did this was to look to see if we could find clues to what happened first. Did the S&P start to sell off? Did the yen start to sell off? Sort of what was the first domino? And what we see here in the dark sort of black, blue, dark navy is the US dollar versus the Japanese yen. This is flipped from the chart that we looked at here, which is the yen versus the dollar. So in this chart, the yen is strengthening, so the chart is going up. This chart shows the dollar over the Japanese yen. So when the yen strengthens, the dollar is going to weaken. And this weakening dollar and strengthening yen is what has sort of been the first domino that fell. So here in sort of early July is when the Bank of Japan raise their interest rates. That was the first sell-off that started to happen. Pretty shortly after that, we started to see the Nikkei sell off, which is the orange line here. A few days later, we started to see the sell off in the broad S&P 500. So you can really start to see that as the Japanese central bank increased those interest rates, that directly led to the yen appreciating versus the dollar. So two things happened with the carry trade. The cost of capital went up and the conversion became more costly because of the appreciated yen versus the dollar. Maybe say that again. Interest went up and the yen went up, and those both hurt returns on the carry trade. That's the bulk of what's happening here. So the yen started first, the Nikkei, then the S&P 500. Pretty easy to identify. The Nikkei, by far the most damaged, was what you would expect if the yen carry trade is the culprit. You would expect the Nikkei to go down a lot. You'd expect the yen to appreciate a lot. And you'd expect some other assets to kind of follow suit as liquidity, as the selling pressure started to spread. Exactly what we saw. So let's look at other parts of the market. So semiconductors, we had noticed a little bit of a rotation. Semiconductors and technology stocks have been incredibly strong. Um, an interesting note that when we look at the yen, semiconductors, and the S&P 500, semiconductors and the yen started to sell off at the same time. So the semiconductors moved before the Nikkei started to move. So there were, this is another one, that another information data point that says, it was the yen, it was the Bank of Japan that caused this little panic. Otherwise, it would not be so correlated in the starting time, in our opinion. So with semiconductors doing that, and semiconductors, a lot of the manufacturing process is still in that Asian ecosystem, Korea, Taiwan, sort of Japan, not really Japan, Vietnam, Indonesia. There's a lot of that uh, infrastructure there. We're trying to build it here, especially in Central Texas, but it doesn't surprise me that the semiconductors have been hit so much in the same way. They were a beneficiary of this carry trade as well. Could be presenting some opportunities here too. So let's switching gears a little bit. Let's look at the VIX. This is an interesting chart. So these big VIX spikes don't happen all that often. And the VIX is a measure of implied volatility. The VIX is on the bottom, this orange. The S&P 500 is blue along the top. And these green dashed lines are previous VIX spikes. It's kind of hard to tell, but you can sort of see the difference between the orange and the green here. So really going back to the late 90s, this was the long-term capital management failure in 97, sort of caused some problems in Russia and emerging markets. We saw a couple of VIX spikes there, but this big VIX spike got up to about 50, pretty much marked the low. Then we had the rest of the tech bubble for another couple years, year and a half, and then we saw the tech crisis. The VIX spike after the tech bubble bursted also marked the low in 2002. The low was a little bit long, it was early 2003, but it was around the low. 2008 was a little bit early, happened in January 10th. The low happened in March. That was a massive, massive move. But it still was pretty close to the low. And that happened a year. This VIX spike happened a year into the bear market. We saw a couple little taper tantrums here. This was a taper tantrum. This is when the debt got downgraded. Both led to spikes in the VIX. Both marked bottoms. We had a China yuan devaluation in 2016, 2015, August 2015. It marked a low. It retested the low a couple weeks later, but it was still a good entry point. In 18, February of 18, marked a low. COVID marked a low. Now we've got a spike up to almost 70. We'll see. But history being any guidepost, these kind of big VIX spikes are not something to sell into. We have this as a part of our process. We mentioned it in the report that we sent out yesterday, but we do have volatility override triggers that we've done back testing and have in certain panicky conditions. Um, as you would think, it's not good to sell. And we had some sell signals yesterday, but they were overridden because of our volatility override, where it does not look like a good selling opportunity yesterday. So, at this point, we're just waiting to see what's going to happen going forward. But here's a sign that maybe this is a very short, isolated volatility explosion that is going to be, kind of reversed here relatively soon. S&P 500. So what are we looking for? A lot of different things to look for. One, it's kind of hard to see on this chart, but we're still above the previous all-time highs. We haven't made a lower low. So one of the things that is characteristic of a bull market, higher highs and higher lows. So not making a low right here at 49.50-ish, that would be good if we can stay above that. But on the upside, what we've got is a sort of a red, yellow, green stoplight kind of a approach here. And these are what are called Fibonacci retracements. They're very common for markets to move into these levels. There's nothing scientific about it. But if we a typical bear market rally, weak bounce could be followed by additional selling would be this 23% to 38% move, where of the move from the all-time high, you get a weak bounce, you kind of flounder around in here and end up making a new low, hopefully above this kind of call it 5,000, 49.50, 5,000. Then maybe we see a little bit of a bigger, steeper rally, and we have to look to what's happening around there. We can get up to the yellow. That would be good. It's still a little concerning because this first low right here is right at this 50% retracement. That's positive because I think that it'll draw market participants to there. I think that's the first big major level to watch from a bullish standpoint. This is a little bit of no man's land buying right here, because it could easily reverse and it'd be a much better buying opportunity down here. But if we do see it, we could easily see a market that just kind of chugs higher over the next few weeks. And if that's the case, then this thing is over. So this 50% retracement, 53.95, 5400, very important level for the market to get over that here in the next week or so. That'd be a very, very, very positive sign. So looking at some other metrics that we don't talk about all that often, but I do want to talk about, there's only I think 3 more slides here. One is US credit spread. So we've talked one-on-one with some clients and kind of mentioned this various times over the years, but credit spreads look at, and we talked about this yesterday in our report, credit spreads look at the relative yield between risky bonds and safe bonds, junk bonds versus treasuries. And what we see is right now it's 190 basis point difference, 1.9%. Really not a big move. These kind of moves happen a lot. This was the '08 move. Here was COVID. So these type of moves, we're not seeing anything really concerning at this point. Bottom line with credit spreads, we're watching it. Similar to credit spreads, one of the risks that we have identified for the second half of this year is China invading Taiwan. They have stated that they want to do that. There is uncertainty in the White House. I don't want to offend anybody who like Biden, but he is not fit to have any kind of decision-making authority, especially for nuclear weapons. So if you're China, maybe you want to take advantage of the dementia patient that is pushing nuclear bombs. So I think that's an increased risk over the next few months. And the one place that I think is a canary in the coal mine with the potential for China to invade Taiwan are credit default swaps. And what that does is it looks at what is the risk, what is the market pricing in the risk of some kind of default from a government bond. When we look at that in Taiwan, if Taiwan is invaded by China, it's kind of hard to tell. They probably default. The market is not worried about a Taiwan default right now. So I don't think the market is very concerned right now about a China invasion. The other thing that this suggests is that this is isolated into Japan. So when we see US spreads, credit spreads have increased, but not that much when you look bigger picture. It's a big move, but it's not necessarily concerning. It's something to watch. This is not a big move at all. The market is not concerned about Taiwan defaulting. Same way with Korea. So if we look at the two most important countries in with as it relates to the U.S. economy, mainly because of the semiconductor and technology infrastructure that's over there, Taiwan and Korea just not showing any real stress. So that when we look at all these different pieces together, it becomes pretty easy to have confidence that this yen carry trade unwinding, causing volatility unexpectedly over the short run, but at this point is really not causing any real damage. The economic data that we saw does not justify the VIX going to 70. A slight miss of payrolls last week does not send us into a recession necessarily. We got to watch it, and it always could be coming. A recession is always a possibility. But when we look kind of across the markets, like I say, we're not seeing this stress spread. It was very isolated. It's the VIX is back down to 26 right now, from 70 yesterday morning. So we're seeing the calm kind of come back. Again, I would stress that the main thing is that we could continue to see a couple more, maybe one or two more little bouts of volatility. If we see that, then I think that's really a nice buying opportunity. The things that we're looking at to buy, there's just some of the questions, and if anybody has any questions on the webinar, please feel free to type those into the chat or into the Q&A. We'll listen and look for both. But if sorry, I kind of lost my train of thought, but we're just not seeing this spreading out of this risk. So the things that we're looking at to potentially purchase, we still like small caps, we still like mid caps. As long as the regional banking crisis stays contained, that could throw off mid caps and small caps a little bit. But we've got some plans to restructure and eliminate some of the financials in small caps if that were to happen. We still think those are going to play catch up. There is still some increased risk internationally. We're not quite seeing that yet. So the international trade, we have a potential sell there if we get a little bit more of a bounce. But the things that we're also looking at are really high quality US stocks, industrials. This is creating some opportunity in the semiconductors. Nvidia is down 25% over the last month or so. So some of these stocks that have been pretty high flyers are creating some opportunity potentially. But I do think that we're going to kind of continue to see the rotation out of tech, continue to see this broadening in other areas of the market. And based on the last couple days move, it really does not look like it's enough to break this bull market just yet. So some other bad things would have to happen. So in order for that to happen, but at this point, it just doesn't seem, like it's too much of a concern. That's our presentation for the day. Hopefully, it made some sense. Hopefully, we're able to clarify some kind of more complicated terminology and happenings in the market. I don't really see much questions. The main questions that we're receiving via email are, what are we going to do? Are we selling? Are we buying? We did buy some small caps and mid caps on Friday. We did not buy or sell yesterday with our volatility overrides. We want to see how today plays out. It's not quite as strong of a rally as I would hope. I was hoping to get a 2.5, 3% rally today. We didn't quite get that, but it was still a nice rally. We'll see if we get some follow through tomorrow. But like I say, if we look longer than the next week, I think we're probably through this period of volatility. So we'll send out recording as if there's any questions. I don't see any questions right now, but if we don't have any questions right now, then we'll send this out as a recording either a little later today or more likely tomorrow, and post it on our socials. And please don't hesitate to reach out directly with any questions. I'll take it back here to the information page here. So we'll post this on our website tomorrow. Email me directly, jim.denholm@ironbridge360.com. Feel free to DM me on Twitter or tag me on Twitter at denholm_Jim. And then we do the LinkedIn and Facebook and Instagram and all that stuff too. So looks like we don't have any answers live. If you do think about some, please don't hesitate to reach out. So thank you all. Let's see here. Hold on for me. Okay, looks like we have a question. Where is it? Oh, I'm sorry. We have two questions. Okay, so one, any indications to move toward heavier weighting into gold and commodities? Yes, absolutely. We've got a fairly decent, got the biggest gold position that we've had since starting Iron Bridge. Balanced portfolio, roughly about 6.5% of portfolios in gold. Gold, like everything else over the last few days, have gotten hit, but it did make a major breakout earlier this year. We've owned it for, I don't know, 9 or 10 months now. It does look like it's going to be a pretty good, like commodities could do well. I don't think we're over an inflationary environment. I think we have upward pressure on inflation. I think we have upward pressure on interest rates outside of these, momentary periods of panic where the bond yields in U.S. Treasuries especially go down in a flight to safety. But I do see adding more exposure to gold. There's some broad commodity exposure ETFs that don't have K1s that we really like. That has been giving us some potential buy signals. So I think what we could be seeing is kind of this rotation, continued rotation out of tech. It's a lot of money has rotated out of it with some of the bigger ones down, 20, 30%. So there's some opportunity there, but I do see gold and commodities being a very good part of portfolios over the next decade. Good question. Another question. Nikkei crash resulted from rate surprise. They were given 20% odds. U.S. markets, 90% odds of a September rate cuts. What happens to U.S. markets if there's no rate cut? Another really good question. So there was a surprise rate cut. The Bank of Japan does not telegraph as much to market participants as the U.S. Fed does, mainly because of some of the media relationships that are very close to the Fed chairman. Anytime, a good rule of thumb, anytime you're a week out from a Fed meeting and you've got over a 90% chance of a move, probably going to happen. I don't remember the last time there was a 90% plus probability that close to a rate decision that it didn't go the market's way. So the Fed they don't like to surprise the market. It was surprising that the Bank of Japan surprised the market, but really since Greenspan, they've really tried to signal what they're going to do to avoid these kind of surprises. Bernanke kind of took this and really ran with it, and was pretty effective at making the markets go up, if nothing else. But If we don't see a rate cut, I think that the market might be have misplaced hope on rate cuts. Personally, I believe that if we see more than two rate cuts, we're in a recession and a bear market. So the possibility of three rate cuts, which is starting to be talked about, I don't think that's going to be welcome to the market. Declining rate, rate cut environments are typically not bullish. I think this is a narrative. We started the year with six projected rate cuts. And so far, we've had zero, and the market's done very well so far this year. So I don't think that, I think the stock market will like no rate cut or like a one or two rate cuts, 25 basis point, maybe 50 basis point rate cut. I think the market might like that. Um, if we see more than that, I think there's a true growth scare that potentially could lead to a recession. The 2-year treasury is much lower than the Fed funds rate. That means the Fed is restrictive. It's restrictive by about 100 basis points. So it would not be out of it wouldn't be unusual to see a pretty big rate cut. But the shorter term rates, the 2-year rates are lower recently, mainly because of this unwind of the carry trade, where you've seen selling stocks, getting into treasuries, paying off the yen debt, different things like that. The main thing with markets is flow. This is a perfect example. Markets are not physics. Just because a company has good earnings, just because GDP is positive, does not necessarily mean that the economy or that the stock market broadly is going to go up, doesn't mean that an individual company is going to go up. Over time, it does correlate, but over short periods of time, it really doesn't. So I don't think a bunch of rate cuts will be positive for the market, frankly. I think it would be more negative because there's something else going on, like a recession or something like that. We're not seeing that right now. I mean, there's some early unemployment data. There's this Psalm rule that you may have heard about that's being thrown around. It just has to do with if there's a 0.8% increase in the unemployment rate, then, certain that could signal that we're in a recession. Illegal immigrants are getting counted in these numbers now as prep for the election. And so there's a lot of manipulation of data, frankly, that's happened. It's been happening for a couple decades, but it's really happening now. So, that's where again some of these economic moves and some of the macro moves don't always correlate with the market because they tend to be more complex than what CNBC will put together in a 10-second clip. So I if there's no rate cut, I'm not as worried about it as if there's three rate cuts, is a good way to say it. Good question. Sorry for the long answer. Any more questions? Looks like that might be it. Again, appreciate everybody for joining us today. We'll send this out, like I say, probably tomorrow in a recording, posted on our YouTube channel and online and socials. But please don't hesitate to reach out with questions. These are complicated things. We don't talk about it all that much. Hopefully, it simplified it for you. But we appreciate your time and attention. Please don't hesitate to reach out with questions and invest wisely. Thank y'all.